Everyone dreams about living an uncommon life, but how we define that dream is very different for each of us. And for most, it's a lifelong pursuit. Welcome to the Uncommon Life Project podcast. We're going to introduce you to people who are living that life or enjoying the journey to get there. We're going to also give you some tools, tricks, and tips for starting or accelerating your own efforts to live an uncommon life, a life worth celebrating and savoring. Please welcome your hosts, Brian Dewhurst and Philip Ramsey.
Hello and welcome everybody to another episode of the Uncommon Life Project, where I am your host, Philip Ramsey.
And I am Brian Dewhurst.
And today we are talking to you as just two friends hanging out because it's a duo cast, Brian Dewhurst and Philip Ramsey. We got a fun one today, and it is just a strategy. We do this from time to time, tips, tricks, and hints for you to live your own uncommon life. And today we are talking about a LIRP. LIRP sounds like you threw up in your mouth. It is a LIRP. It is a life insurance retirement plan. What in the world is it? Why would you have it? And the ins and outs of it. Hopefully this gives you some ideas of quirky ways that you can live your own uncommon life, or if you have a business already, it could be a fun bolt-on. We're going to try to go the ins and outs of this. I think we're really good people to talk through this. So where do we start? What is a LIRP?
LIRP. We've always wanted a noisemaker on the show, and now I feel like we get to do it. Yeah. If you've been listening to the show, you know that we kind of call it uncommon banking, and trying to show people how they can borrow against cash value life insurance to do things now, like, buy off their cars or credit cards, or invest in a real estate property, or start a business, and the money still compounds. And focusing kind of on what you can do with life insurance now. This strategy is really the back end to that. We kind of cover it when we meet with people, but the industry calls it a LIRP. So we kind of just felt like, let's identify with the LIRP. And I feel like we're going to see how many times we can say LIRP in this show, but let's talk about kind of the back end. This is the benefit of kind of uncommon banking, or, loading up a life insurance policy with cash value. This is the back end. This is the retirement income.
Income part of it. When he says back end, he means the cash flow side of
passive income.
Yeah,
is
right.
The big buzzword going around.
Yeah, and the taxes behind the takeout of all of that. It's cool. Okay.
So, and we've been doing a lot more. We've got a new tool, new software to play with to model retirement income that is kind of blowing my mind, and it really does a great job of showing what account you should take money out and the sequencing of that. And, when you look at all the main ways most people are going to get income in retirement, they're all taxable. And so a LIRP is kind of like a Roth IRA from a tax standpoint, with way more advantages, in our opinion, than potentially a Roth IRA. So we'll kind of dig into that.
Right, because when you're in retirement, I'll tell you one thing that will get you, two things maybe. I would say inflation, and then taxes are something too that people are really looking hard at, and like wondering, how do we combat this now? And even when we're a little bit younger, what can we do as planning now to then combat that in the future? This could be a strategy that people could use. Am I right?
For sure.
Okay. So where do we start with this? And I definitely want to identify, like, who is this for? Is it just for business owners, or is this, our friend Wells Fargo? Is this an employee-run thing? Like, tell me about that.
Well, I think this is for lots of different people. What is a LIRP? Life insurance retirement plan is basically loading up a life insurance contract, cash value. Cash value. You can either do this with a whole life contract. You could do this with a, index universal life contract. You could do this with a variable universal life contract. And so you're loading up a life insurance policy, trying to build the cash value. And then in retirement, you're pulling that cash value out, either via a surrender of cost basis or via policy loans. And both of those are tax-free sources of income. And so one of the real advantages, life insurance gets such a bad rap, right? Just because everybody hates it. I wish it wasn't even called life insurance.
I know.
Like they misnamed it.
They really did, but it's hard not to name it anything else. But the thing that's different than what other people do is normally what people are doing is trying to buy as much death benefit as they humanly possibly can with the least amount of cash outlay for their monthly expenses.
Premium and cash, yeah.
Right. And so this is different because they're structured in order to build what? Cash. And so in order to do that, they actually make the death benefit do what?
We want the smallest amount of death benefit for the most amount of premium.
Yeah.
And so it's kind of the complete opposite design.
Right. And so I think this is where I would maybe challenge the listener to think like this is maybe a different way to look at life insurance than they've even looked at before. Or if you're a longtime listener, it's a little bit like you said, the uncommon banking strategy.
Yeah.
So I think that's just something really quick just to take a quick look at the actual life insurance itself and say we're structuring this way different than normal. And we really do want the cash value to grow because of the benefits you just talked about. We want the tax-free, the tax benefits of the cash value.
Yeah.
Okay.
When I look at it too, when you look at philosophical argument or approach to building wealth, I think Dave Ramsey, not your uncle, came up with one of the best. I don't know if he came up with this, but he's a proponent of it, is buy term and invest the difference. The problem is most people don't invest the difference. And so one of our clients that's doing this strategy, I would say doing uncommon banking and, looking at it as a LIRP. To me, this is like the cherry on top of uncommon banking, but you could look at it in isolation of just the LIRP itself.
Yeah.
He's like, it really has forced me to put money away I otherwise probably would have spent. Like, I think when you do buy term and invest the difference, it's hard to be honest with yourself of like, no, I need to save this extra $2,000 a month, because I'm buying term insurance. It's a very slippery slope to just spend that money, especially right now.
It's valid.
So it kind of, the way we talk about it with people or, when we show this to clients or prospective clients is think about like when you're in your high school gym and you're standing at mid-court and the scoreboard's on the wall, what number would you want to see on that scoreboard, from 5 years from now, 10 years from now, that you could save outside of your retirement plan, outside of your company work plan? And then let's try to go after that number. Even if we come up short, you're going to have more money than you probably would have. Right. And then when you build that into the life insurance, that you're getting a bill for that amount annually, and you are more inclined to put that money in there. Your investment brokerage account or like buy term invest the difference, you don't get a brokerage bill of like, hey, you need to save $20,000 this year. You're probably just going to spend it. So that to me is one of the biggest advantages of the LIRP is it's going to force you to put money away.
So it's for everybody. It's not just for business owners, it's for employees. Okay. And then let's just talk more about, there's a lot of things that we can talk about it. So how do you use and how do you fund it? Like if you're just an employee or versus you're a business owner, it sounds like they're probably two different answers.
Yeah. Obviously the more money you make, it's probably more advantageous for you because there's a limit on Roth. So, the more money you make, the more taxes you're going to pay. I'm talking about like W-2 income or 1099 income, self-employment income. The more money you make, the more taxes you're going to pay, which typically lends you to doing, like a traditional 401k or a SEP or a simple, where you're getting the tax deduction in the current year because you want to lower your taxable income. Mm-hmm. If you do Roth in that situation, you're paying taxes on the full boat and you're not, most business owners or most high net worth people aren't doing that, aren't biting the bullet each year to fund the Roth 401k.
Right.
So then if you look at, if you make too much, you can't do Roth, or let's say you even make a little bit less and you can do Roth, you can only put $6,000 in there. If you're under 50, there's just not a lot of money. So this is really for the people that you're making double digit monthly income. Let's say 10, 15 grand or more is hitting your bank account. And you're only spending 8 to 12, and you could save, $2, $3, $4, $5, $10,000 a month after maxing out your retirement accounts, and you need to put that money somewhere. The real two alternatives or three alternatives is a brokerage account, 2 is, paying off debt or buying real estate that produces cash flow. A lot of people don't want to do that because of the work it requires.
Right.
And then 3, a LIRP is a really great place for those people to store excess, cash that they don't need and a forced savings kind of scenario.
Right. Do you get a deduction for starting something like this?
You do not. It is like a Roth IRA. You're paying the tax on the amount. And so this, I'd say, is for the people that are maxing out their retirement plan at work, or you kind of mentioned Wells Fargo. If you're sub 50 and you can put $20,500 away, you could still save. This would be a great vehicle for you. So,
okay.
Yeah.
All right. So how do you use a LIRP then?
The advantage of the LIRP is the cash value is essentially liquid to you the whole time, whereas, obviously a Roth, you can't really touch it meaningfully until you're 59 and a half. I know they have some caveats like your first time home purchase and some of that, but we're kind of talking beyond that stuff. And so, you can take a policy loan against the cash value the entire time, or the beauty of life insurance allows you to essentially dictate when you pull money out, what kind of money are you pulling out? Are you pulling out the growth, or are you pulling out your cost basis? And like I said earlier, if you pull out your cost basis or you take a policy loan, that money is non-taxable to you in the current year. So that's really how you use it. You can essentially, we can set it up with the insurance company where they're sending you a monthly paycheck, like a personal pension, and you get paid every month in retirement. That's kind of the goal, or, you can set it up quarterly or semi-annually or whatever, but that's the goal, is you're taking a monthly or annual income stream from this policy to facilitate a portion of your retirement income. And that portion, ideally, for most of the time, is tax-free.
Right. So let's talk about funding. Do you fund it monthly, annually, quarterly?
You can fund it any of those different ways.
Okay.
And especially if you use like an indexed universal life policy, you can put it in a lot more flexibly than whole life. And so it kind of just goes towards your risk tolerance of, which policy you want to choose. But I definitely want to do a show after this too of talking about, like with some accountants about what does a zero income tax return look like? What if your tax rate was 0? Where would the money need to come from? And I know one of the answers to that conversation is going to be life insurance. It's just a very flexible and tax favorable environment for money from a tax perspective. So.
It has to be the sad part. Okay, who needs life insurance retirement plan? Or I would like to call a LIRP.
LIRP.
You knew I was going to say it.
LIRP.
LIRP.
I think it's advantageous for everybody. I mean, more so, I'd say executives, business owners are the easy answer. When you look at the millionaire next door, where you hear kind of like, they have 6 to 8 streams of income, this could be one of those streams. And so if you have real estate income, you have Social Security income, maybe you have a pension income, you have 401k income, you could have income off of a life insurance policy. And so the advantage of that money coming from life insurance is it's more flexible than any of those other sources, because there are no required minimum distributions on life insurance. There is no, like once you turn it on, you have to take it forever, like, income riders or a pension. Social Security is largely that way. You only have 12 months to make any adjustment once you file Social Security. So a lot of those forms of income, and mind you, all those I just mentioned are 100% taxable to you. So a lot of those forms of income are rigid once you turn them on, and or the government's requiring you to take them, like a required minimum distribution on 401ks or qualified accounts. And so life insurance doesn't have any of that. You could take out $100,000 one year and take out 0 the next. And so it's a great tool to, massage, if you will, your tax return or your cash flow in retirement.
Yeah. Anytime we use massage and money into a podcast, I feel like we should get like 30 points.
I think we should almost like start trying to pick a word before we start the podcast and see if we can incorporate it.
Okay, so let's go to, I'd love to just talk through, because like there's a couple things we're talking about. One, a 401k. So what's the difference between a LIRP, 401k, and even like an IRA? Some people might. So like doing kind of like going through pros and cons, maybe of each. I don't know if you can even do this off the top of your head. This might be a lot to ask, but
I think let's go to the cons of this, because obviously we're doing a podcast on it and it sounds like, oh, why wouldn't everybody do this? It sounds amazing.
Yeah.
So the fees and costs, obviously it's life insurance, so it's going to come with a higher cost than, directly indexing into the stock market or buying individual stocks. It's definitely more expensive than that. Two, the returns can be less than what you would typically get in the stock market because it's a life insurance product, and so it's not a direct investment vehicle. Mm-hmm. So the returns or the upside might be capped. And so third is just the ongoing cost of carrying the death benefit. I kind of always use the analogy, McDonald's has a cost to build a cheeseburger. Well, a life insurance contract has a cost to carry a death benefit. So all of these things can be negative. You could even view, in my opinion, the premium as a negative. You're getting a bill, it's got to get paid. And so some people, in the way they're wired with money and their mindset, they would view that as like an expense as opposed to an asset. Mm-hmm. And that would be harder for them mentally to overcome of like, I don't want to keep paying this, what's the advantage? And so I think when you look at a LIRP specifically, like you've got to look at the back end cash flow take and the tax favorable and the liquidity and, those types of things more specifically as a purpose of putting the money in.
Yeah. Okay. So I know a lot of our listeners are going to ask their accountant, tell me about a LIRP. And I don't know if they really want to know the answer or they just want to say LIRP. So what do you think the average accountant or CPA would say when all of our listeners, which there's a lot of them, shout out to all of you, walk up to their CPA and say, tell me about a LIRP. What do you know about them?
Yeah, I don't honestly know that many accountants would even know what that means.
Oh.
Two, it's been my experience, I don't want to speak for you, but with all the different accountants we've worked with clients, prospective clients, it doesn't seem to me that a lot of accountants and CPAs like cash value life insurance. And again, they're not all created equal, too. We don't like most of them either. It has to be designed very specifically and, as part of a very cohesive plan.
Comprehensive.
Yeah. And so I would say it wouldn't be favorable. But then when you flip the conversation of what are the sources where I could get tax-free income in retirement, the answer is very short. Roth and life insurance. And I'm sure there's maybe some other quirks out there, tax-free municipal bonds, if interest rates were to go back to a more normal level, treasury bonds. There's multiple answers beyond two, but from an overall structural standpoint, Roth and life insurance are two of the main structures to generate tax-free retirement income.
Okay, so you're telling our listeners they can't use the word LIRP, is what I heard. No, I think that's wise. Here's something that I think you did pull out is sometimes I think accountants or CPAs, it helps on how you ask the question that will help you deduce what the answer is. Because there's a lot of preconceived notions about different things. And if you ask it and you address that, they might have a different answer than if you just, they hear life insurance, like shut it down or whatever.
Right.
So what are some quirky things I think that they can look at and who can get them into something like this? And how do they even go about learning more information about it? Things like that. And what are some quirks if they do ask some random advisor, not us, which seems really weird if they're listening to our podcast. But if they are, what are some things like pitfalls that they could maybe see out of a proposal, let's say?
So I think you'd want to be very leery of a proposal that didn't have a significant amount of cash up front. So if you're going to put in whatever, $30,000, $50,000 a year for 10 years, and I just like round numbers, so I'm not trying to make the number big, but let's just say you're going to put $50,000 in a year premium. If your cash value is not above, I would say 25 to 30 in year one, I would be very hesitant to continue down that path.
Mm-hmm. Or let's just get a different opinion too.
Yeah.
Yep.
So you definitely want some significant upfront cash value to this.
Because if you remember, we are structuring these for a high cash value so it can grow quickly.
And if something goes wrong with the plan and you need access to that money, you don't want that to be a goose egg for the first 5 years.
Amen to that.
So that would be kind of one thing to look for. Two, I think in terms of like, who is this for or why would you use this? Maybe take a step backwards. But, you can't really meaningfully touch your 401k money before you're 59 and a half, even Roth IRA money. If you really want to retire sub 59 and a half or have time freedom, maybe you're still doing stuff and generating income, but you want more time freedom. This is an asset class that you can tap for income and liquidity prior to 59 and a half without penalty. And so it's a very flexible asset when you look at the stages and phases of life and putting together a plan.
When there's a lot of cash value in it.
Right.
Yeah.
So I kind of forgot your other point there. But
okay. So who can get something like this for them?
I think any licensed life insurance agent would be able to help them in
and
theory.
I think another thing that I would say is a pitfall is having an increasing death benefit. That seems like your death benefit should always be a little higher than your cash value would ever be. Something to watch out for. Like if your cash value ends up being the death benefit and it's like pretty early on in the contract. Now later down the road when you turn into be like 80, they might be the similar. But even early on, you probably want to make sure that death benefit is increasing, not staying the same. That's some other pitfall that I think I've seen in the past.
Yep.
Okay.
I'm trying to think what else. I think we covered it.
Okay. So anybody can get up to it. So this is where I think it's interesting. It's the life insurance retirement plans. And the retirement plans makes me think of like a business owner or somebody that has access to something for a retirement plan, because that's normally who, I guess, applies retirement plans the most, right? Mm-hmm. But this isn't really what that is. You don't have to have a business structure.
Yeah, it's for anybody. It's just a liquid savings account. You can access it month one. You could access it 30 years from now. It's just like a forced savings account. And then, like I said earlier, you can do it with whole life. You can do it with index universal life. There's different vehicles of life insurance that you can do based on your risk tolerance. And, that I think is maybe a separate show, but
right.
Yeah.
So let's do last thing. And we've kind of danced around it, but just patient type or person that this is ideal for. And I think it's interesting to know that, it could work for somebody, not this, but in an ideal world, I think you've already painted it, but I think let's just reintroduce that kind of like, oh, this is me.
Yeah.
Maybe I should think into
Definitely entrepreneurs, business owners. I think especially too, if you have a younger family, like dual income, you're like 25 to 35, like really young, and maybe you don't want to max out your 401k yet because, you're maybe trying to upgrade the house that you're in or you've got private school for your kids. And so you have more like after tax expenses. And so you're trying to, still build the lifestyle you want. You're not in a place to overfund. I think that's interesting. Or you are maxing out your retirement plan. You still have excess cash flow to save and you want it to be tax protected, because if you're making that kind of money, you don't want to make after tax, income off of dividends and that type of stuff, or capital gains exposure where you're buying and selling stocks. It's just going to amplify your tax problem. This is a way to shelter you from that, but still get upside exposure to the stock market without triggering excess taxes. And so, and then, people that want multiple uses on their money. I would say people that want to do, we have a lot of people that use this in concert with buying single family homes, duplexes, rental properties. It's a great place to get down payments for multiple properties. Because you're forced to sit on excess amounts of cash if you own real estate, and this is maybe a better long-term storage vehicle than just leaving it in the bank.
Yeah, I also think like somebody who's have great cash flow. So let's start there. So $10,000 to $15,000 to $25,000 to $40,000 a month. That's coming in, and they've already maxed out their 401k. This is something that seems like it could be a really good fit for those people.
Totally.
Because ideally, you just want cash flow that you want to try to do something with. And then we want to put it into some environment that will grow tax-free, but we don't want the burden of the Roth. And you could do a Roth conversion.
Yeah.
Here, say that you can totally do that. But at some point, you need access to be putting away money for retirement. But also, I love it that you have access to it before retirement if something were to happen. or you have an amazing opportunity, you can pull that cash flow or cash value out.
I just want to compare it to the Roth really quick because I think this is super important. In a Roth, let's say best case, you can contribute to a Roth and a 401k. If you're under 50, the amount you can put in max is $20,500 a year. If you're over 50, it's like $26,500 or something like that. Maybe it's $27,000, I think, for 2022. So that's a big number for people, but there's a lot of people making way more than that.
Yes, a lot of people.
And if you're not over the income requirement to do Roth, and you're doing Roth outside of your retirement plan, it's only $6,000, and if you're over 50, it's only $7,000. Mm-hmm. Well, if you have an extra $50,000 to $100,000 a year in cash flow, it's so tiny it doesn't even move the needle. And so we can structure these premiums on life insurance, and again, structuring them with a pretty high cash value up front, where your premiums could be $50,000 to $100,000, but again, that's showing up in cash value, so it's not gone from your economic engine. And so we can put that money away. So it's like the question is, if you could put $50,000 to $100,000 a year into a Roth,
would you do it?
Would you do it?
Right.
And I think there's a lot of people out there that would. They just have never been shown this. And then if you put that money into a brokerage account, are you going to truly save as much as you probably could? I don't know. And then B, let's say you are, and you want to buy and sell stocks, or you're doing any type of moving inside that portfolio, you're probably going to trigger capital gains, which is going to move the needle on your tax liability. So this gives you the upside potentially to the stock market, depending on the vehicle that you use of insurance, and shelters that money from tax.
I do think, though, it's probably not for everybody, right? Like, this is definitely not for everybody. So if you hear like, oh, it's for me, and maybe
you have to understand it and you have to appreciate it. And I think it has to, like, you always do a great job of saying, like, everything's about risk tolerance.
Yeah.
And if this fits your risk tolerance and you understand it, it can be a great vehicle. If you don't understand it or you don't like it, there's going to be friction there, and you should probably just not do it.
Right.
We heard a guy today, actually, he said, if you're thinking about, if a decision is murky, that means no. Like, if there's a spectrum of the decision is like yes, maybe, and no, maybe and no go together.
Yeah. I love that.
So anyways.
Okay. Well, I think that at least gives you a little bit of exposure to a LIRP, life insurance, retirement plan. Thanks for your time. Thanks for listening.
Thank you.
You've been listening to the Uncommon Life Project. I've been your host, Philip Ramsey.
And I'm Brian Dewhurst.
Till next time, have a great day.
And go be uncommon.
Bye.
That's all for this episode of the Uncommon Life Project, brought to you by Uncommon Wealth Partners. Be sure to visit uncommonwealth.com to learn more about our services. Don't miss an episode as we introduce you to inspiring people who are actively pursuing an uncommon life.